Right? All right, how do we, if you can hear my voice, clap your hands twice. Good morning. Thank you, Amber, and only Amber. Good morning. Good morning. Thank you, everyone else. All right, welcome back. I hope folks have a little caffeine. I hope folks are getting settled in after a pretty lovely farm dinner last night. For those joining us remotely, welcome, good morning. Thank you for coming back for the fourth and final day of the live stream. We're gonna get started in just a second, but same housekeeping as usual. We're gonna keep your microphones muted and your cameras off. We are recording this session, which will be available to all. Access to those recordings will be made available in the next week or two. And then otherwise, you should know the drill by now, we hope, but please put your questions into the chat box, and Katie, sitting just off camera, will help to relay them to the speaker. And the speaker in this case, Peter Stein, as you know, Managing Director of Lyme Timber. This session in particular, we've been talking about a number of different flavors of money this week, but today thematically is meant to go a little bit further into the universe of private investment capital. And part of what has brought a lot of folks here to the course, as we learned during the introductions, was the desire to demystify many a kind of operation, many a dynamic within the conservation finance space. So this presentation in particular, who, what, and why is a conservation investor, is really geared to do quite a bit of that within the context of private investment capital. So with that, Peter, if you'd like to take it away.
Well, great. Thank you, Leigh. And I am so pleased to be now presenting or partnering or joining my 16th Conservation Finance Bootcamp. And this is the repeat visit to CSU Fort Collins. Leigh mentioned this, but unfortunately for those on video, you're not about to understand, but that was a pretty exciting evening yesterday for me. Rainbows, lightning, great food, like, yeah, pretty good. A number of you know that I wear a variety of hats, like co-founder of this network, very involved with Mike at the International Land Conservation Network, but I actually do have a day job, and it's with the Lyme Timber Company, and for better for worse, I get to work with Kit. You met David Hoffer on Monday and Tuesday, another one of my colleagues. So Lyme Timber, I'm going to kind of use as an example throughout this presentation. We are arguably, still are probably, we were the very first private investment entity that put impact capital to work in the natural resource space. So we've been doing it for about 30 years, and we have absolutely made more mistakes doing this than anyone else, but we do internalize and learn from our mistakes. But to get us started, we are not advancing the slides.
We just need to click to the other window, the thing we keep forgetting to do. And then we're going to give it 3 seconds. Oh, there we go.
Okay. Great. So I think this may have been one of the reasons why you're attending boot camp, which is there is a remarkable amount of private capital available, not just in the US, but across the globe, that would like some direction. It would like to find its role, find its place in the real sustainable real asset investing milieu. And land trusts and conservation NGOs can actually be guides, partners, helpers, facilitators of bringing that capital to natural climate solutions, to permanent durable land conservation efforts, to restoration efforts, to a variety of the conservation outcomes that all of you are working on. But just to give you a sense of what impact investing is, I don't always say this to our so we have a lot of private grant-making foundations who are investors in Lyme timber. They take their endowment and they do lots of things with it, and a little bit of it gets invested in Lyme timber. But I never say this out loud to those foundation clients. When they make a grant, they lose all their money. Now, they achieve their mission, but they don't get a financial return from a grant. So in the context of the endowment, they can make an investment in something totally unrelated to their mission. Hopefully it's a good investment, makes money for them, and that is the resource or builds the endowment so they can make grants. But starting, actually, we had the very first impact investment from a foundation in the early 1990s. Foundations have started to realize, why don't we put the other 95% of our assets to work? And now they're, in the US at least, there are about 350 foundations who are regular investors in mission-related, programmatically related investments that also deliver what their grants deliver, but they get a financial return as well. And Lyme timber is an example of that. So traditional investing may not have any connection to their mission. Socially responsible investing is a little more of do no harm. So avoid tobacco. Years ago, avoid South Africa. No longer. You should invest in South Africa now. Avoid nuclear power. Those kinds of things. So it's sort of avoid certain types of investments. Impact investment is to affirmatively go to investments that are going to deliver the mission of the foundation as well as the financial return. So if you're a healthcare grant maker, why don't you invest in the development of a rural health clinic, which might make money, but it is also delivering health services to an underserved population as well. If you're an environmental grant maker, why don't you invest in sustainable land management's regenerative agriculture fund? Because you care about regenerative agriculture, you're going to make a return on that investment that is both financial and mission related. So that's where I'm trying to get with this slide. There is a sense out there that all impact investments are below market. That is not true whatsoever. So many impact investments are financially competitive with traditional investments. To be positioning Lyme is both a financial, the way I will say it without sharing too many details is we beat the index of all timber investment managers financially, but we also deliver durable conservation and rural community development benefits as well. So there doesn't have to be a trade-off, but there are certain foundations, certain family offices, certain insurance companies, certain pension funds who've elected to receive lower than conventional returns, so-called concessionary returns on their investment, because that's necessary to deliver the mission component of that investment. This is a shortcut to sort of the ecosystem of players in the investment, particularly the impact investment world. So who invests? I mentioned foundation endowments. I mentioned, so any of you live in Chevy Chase, Maryland, or anywhere in Montgomery County, Maryland? So the Public Employee Pension Fund for Montgomery County is an example of a public pension fund that invests in Lyme timber. We have a coalition, it's a cooperative of Swiss company, private Swiss company pension funds that aggregate their investments together and they invest in Lyme timber. I don't want to pick on them, but if any of you met Martha and Rich yesterday, they're happy to say they're a family office that invests in Lyme timber. Mighty Arrow, who presented on Tuesdays, as an example of a foundation endowment that invests in Lyme timber. And I'm just using Lyme timber as an example. They're making lots of mission-related investments, Lyme timber just being one of those. So in that case, actually in almost every one of the cases I just mentioned, except for Mighty Arrow, they found us directly. Nobody intermediated or managed or facilitated that relationship. Most of our investors go through a registered investment advisor. And so this is a company, and they're all around the globe, whose business is to identify good investments and match make those investment opportunities or investment products with their client base, which might be family offices, endowments, college endowments, foundation endowments, healthcare endowments, public and private pension funds, insurance companies, etc. There also are aggregators of investees, meaning aggregators of managers, deployers of capital. So Lyme timber is an investee. That's the technical term when you look at the investment world. So we're receiving capital from third parties, also known as other people's money, and we're deploying it. A couple of entities out there have, so Sonnen Capital is a registered investment advisor, but they also have their own proprietary product. So they went around the globe and picked 10 underlying investees. So if you invest in their real asset fund of funds, you get exposure to, believe it or not, green affordable housing in Cape Town. You get exposure to Lyme timber. You get exposure to Dirt Capital, which is doing farmland conservation in the Northeast. You get exposed to they changed the name, but it used to be called Microvest, which is doing microloans. So they found supposedly, I'll take it as they say, best-in-class managers in 6 or 7 silos. And for a single investor, they get exposed to all of those things. And then lastly, a number of the wealth advisors, so Wells Fargo, I'm using as an example because we have about $60 million of their clients' money, they create a platform. So they say, well, when let's say Lyme timber is raising capital, we're going to do the research, ask all the difficult questions, and if the answers to those questions are satisfactory and there's a proven track record and the strategy makes sense, we're going to put Lyme Timber's fund on a platform, which means we're pre-approved for any one of their clients to invest with us. And not on this slide, but the next time I do this slide, I'll add it. There's now platforms to access donor advised funds at community foundations and the commercial donor advised funds. And CapShift is the example of that. And we do not have time. Maybe when we get to questions, we can talk about that one a little bit more. So just so you know some names who populate this ecosystem, I always put Lyme timber first, but these are some of the other private impact investment managers in the sustainable real asset space. And it's growing. When I did this slide in the first boot camp, there was somewhere between 1 and 2 examples on it. So over the last 16 years, and this isn't complete at the moment, there's probably 5 others that I'm missing at least. So for me, it's an indication, and quite candidly, part of Lyme's culture, we actually incubated Dirt Capital. We incubated ecosystem investment partners. If we're the only thing populating that box, none of the people in the next box are going to spend the time paying attention to us. It's not a big enough asset class. There's not enough variety. There's not enough opportunity. So by growing the amount of investees that are delivering sustainable real asset conservation as an outcome, I think it makes life easier for the folks in the second box to dedicate the staff time to keeping track of the field, staying up to date. We have someone from the UK who does this during her day job. So that's one of the reasons I'm personally dedicated to eventually seeing many, many more so-called investees in that box. And then lastly, there are folks that are kind of in between. The old term that I'm using is a merchant bank. That's a term that actually isn't used as much as it used to be. But these are folks who sort of get in between these boxes, may have some direct relationships with investors. You could also call them thought leaders, facilitators. I put Stephanie Gripney, who joined us for dinner last night, in this box. These are folks who are expert at understanding the ecosystem and making the linkages and connections that are necessary. NatureVest plays it both ways. They also raise capital directly, like their Blue Bond work in Oceania, or the Cumberland Forest Project in Virginia, Tennessee, and Kentucky. So why would you bother to learn about this stuff if you're a land trust? Well, I find it fascinating, so I hope you do, but that's not really the reason. The reason is part of my personal migration from working for a land conservation NGO to becoming a capitalist. There's just a tremendous amount of money out there. And I think it's kind of part of the responsibility of the land conservation NGO movement, both here in the US and globally, to bend, to influence how that private capital gets deployed and invested. An example for Lyme timber is more than half of the investments we've made over the last 30 years, the prospective investment was brought to us by a land trust. So that means that there are hundreds of people running around the United States. Well, they aren't running around, but anyway, there are hundreds of people who've gotten to know Lyme timber, whether they work for the Trust for Public Land or the Conservation Fund or Maine Coast Heritage Trust or Pacific Forest Trust or Palmer Land Conservancy or Colorado West Land Trust, who understand our business, understand our strategy, understand when we're going to say no so they don't want to waste our time, and are finding deals for us. Well, that helps us. Why in the world do they find deals for us? Because they can't do them by themselves, or they can't do them with their more traditional partners. A lot of that has to do with scale and time. We have a 5-person investment committee. We can make, if a prospect comes in on a Monday and we can kind of figure out if it's worth doing, we could make a decision on Wednesday. If I mentioned that out loud in front of the Nature Conservancy, they would say, no, it takes, anyway. So many land trusts are just incapable of what I call making decisions at the timing of a market. So of course you want to work with patient sellers, and of course you want to have an inexpensive option that gives you control of the property for the next 3 or 4 years. But that is not always the case that you're running into when you're looking at a critical property to acquire and conserve. The second reason is money. So some landowners, okay, we'll make a gift. So you don't need us if it's going to be a donation, or maybe it's an extreme bargain sale and you have enough money for the consideration for the bargain sale. But sometimes you have to pay fair market value. And sometimes you're not going to get seller financing. And sometimes it's going to close in the next 60 days. And so the ability to access dollars at scale is another reason to understand this, the kind of work that, whether it's Lyme timber or a number of the other, like Blue Source. Blue Source used to be a carbon project developer till a year and a half ago when they got a $500 million commitment from Oak Hill Partners. They're now a carbon TMO, and they have partnered with conservation groups already. They're doing some deals on their own, but that's a great group to talk to if you are looking at forest property where you think there's a chance of a carbon project and it's trading in the marketplace at a very rapid rate, and you're not going to have the dollars to control it. New Forest would be another example of that, particularly in the Pacific Northwest, although they've made some investments in the Southeast as well. There's also an issue around working forest lands. Notwithstanding the great work of a group like Pacific Forest Trust or Society for Protection of New Hampshire Forests, which are land trusts that have internal skills and capacities to do some degree of forest management, none of those can work at the landscape scale. So the TIMOs, the Timber Investment Management Organizations, either by using third parties or in the case of Lyme Timber, by having dedicated operating companies, we're knowledgeable, experienced in the business of actually managing forest land. And we go one step further. We are probably the most experienced TIMO in managing third-party certified forest land. So complying with both Forest Stewardship Council and Sustainable Forestry Initiative protocols. And lastly, and I mentioned this in the context of Kristen and the military, I'll pick on Pennsylvania because there's a number of people from Pennsylvania here. Having the Nature Conservancy go buy something in the north central part of Pennsylvania is not a really good idea unless they're equipped with Kevlar. I don't know, Michael, you might disagree with that.
We're over $500,000 to pay off the local school district and,
Yeah, right.
and other taxing jurisdictions to be okay with the deal. That's the.
There are, I think, local political situations, regional political situations across the country where having the private for-profit sector actually be the leader of conservation. This happened very specifically in Wisconsin 9 or 10 years ago, where the politics dramatically changed in the state of Wisconsin. Everybody forgot who Gaylord Nelson was. And I don't think the project that we did in partnership with the Conservation Fund and the Nature Conservancy could have worked if Lyme Timber was not sort of the lead actor and acquirer of that land. And quietly, sort of in the background, we got the benefit of the GR and the government relations knowledge and the local knowledge that those two organizations had, but their political capital was sort of at the zero level at that moment in time with the legislature. So it really required the private investor to be communicating with legislative committees and the governor's office to secure the public funding that was necessary for that. So I'm not going to even do anything.
Can I make one comment?
Yes.
There's one bullet that I would add to that I think is really critical, which is in the pre-reach from the Paulson Institute, it talks about the funding gap for biodiversity and conservation. I think something like.
Sorry, we need to get the microphone.
Oh, I'm sorry.
And name and affiliation.
Grant Mulligan, Tiedemann Advisors. In the pre-reach for this boot camp, there's the Paulson Institute report on the financing gap for biodiversity and conservation, and they put it at an average of $711 billion needed a year for the next 10 years or so. And I think the private capital NatureVest's goal is to bring more capital to conservation. So when I think about impact investing, all the things you wrote, that's absolutely true, especially for individual land trusts. But at a more macro level, I think private investment has a really big role to play in solving some of the bigger challenges and getting capital where it's desperately needed.
I'm only going to agree with you. But I thought I'd actually let you look under the hood for a moment of one of our funds and look at the characteristics of the underlying investors. So the way Lyme Timber works, like many private equity funds, is every 4 or 5 years, we raise a fund. And that means we receive capital commitments. Nobody sends us a check. They just sign a document that says we can call their capital, we can ask for their portions, the pro rata portion of their investment that relates to each one of our acquisitions, as long as we provide 2 weeks notice. We've been doing this for a long time. We've only had one LP fail to respond to a capital call. So meaning that we've had a number of thousands that have actually responded to their capital call. But who are our investors? So a little more than a quarter are foundations and endowments. So this would be the endowments of a foundation and college and university endowments. A small portion of the fund of funds. There are 3 fund of funds that invest in Lyme timber, but it's a modest part of our investor base. High net worths and family offices and pension funds. Of the 2 pension funds, 3 pension funds that invest in that fund, 2 are impact investors and 1 is just a average conventional fiduciary. We used to have this little test that would drive me crazy because it only uses electrons. We don't send out printed impact reports, but a number of our conventional, we'll say not fully evolved investors would opt out of receiving our impact report, which like, really, come on, but so what that means is about 50%, in this case, Fund 4, about 50% of the capital that went into Fund 4 came from self-identified impact investors, and 50% came from regular, conventional investors. As you can see, this has been changing over time. If you go back before Fund 1, Lyme timber had a capital structure that was more or less long duration, evergreen, something that we actually may do again, but stopped for the past 25 years. And at that point in time, there were only 2 impact investors in Lyme timber in the original capital base of Lyme timber. So the number of impact investors and the dollars that impact investors have been growing, but so have conventional investors. And then I get really confused, particularly around European investors, because they do not identify as impact investors, but they ask more questions about mission and carbon and climate and biodiversity than any of our impact investors in the US, more or less. So what I see happening is that someday soon, we're not going to be doing this because more and more of the investors are just somewhere on that spectrum of mission related. And we have a question from the audience.
Yeah, so Jordan Howell asks, why do you think that Fund 4 has the greatest ratio of impact/non-impact investors?
I have no idea. I'll tell you. So Fund 5 has 2 very large investors who did not want to be categorized as impact investors, but asked a lot of questions. So I probably should have a more dynamic slide where I can move this up and down based on what my comments are. But one of those is actually the university that Brad works with. So. I think David touched on some of this, I hope. I'm not going to go into this, but for us, this is what we convey to our investors. This is how we deliver both financial returns and mission or conservation related returns. We cut trees, lots of them, on a regular basis, all the time, big pieces of equipment. You would get scared standing next to most of the equipment we would use. I mentioned we build and populate and manage operating companies, which is something that some of the other TMOs do as well, but we do it without it being a profit center. So being very technical for a second, the operating companies are not owned by Lyme Timber Management. They're actually owned directly by the funds. So an investor in our funds actually owns a piece of the operating company as well. That's very good for the investor. It also eliminates any potential conflict about how much time and effort we're going to spend on a piece of property. And lastly, it allows us to sell property, not just as a forest, but as an ongoing business. So an example of that is we owned land in the Adirondacks in New York State. It was owned by Fund 2, even though I loved the property. We knew we had to get rid of it because the fund was coming to term. We recruited an investor. We went through a process. We had 3 appraisals to show that they were paying more than what we thought another investor might come through a public auction. And they asked to buy not just the forest, but the operating company as well. That investor had never directly owned forest land before. So if they didn't have the operating company, it probably would have taken them a year or a year and a half to build out the infrastructure to generate income from that property. They made money on the first day that they owned that property. Our investments so far delivered about 1.1 million acres of perpetual conservation easements as part of our strategy in the US and in the province of Quebec. Although in Quebec, they're called a servitude, not an easement. And we have about 350,000 acres enrolled in 100-year improved forest management carbon offset agreements in the California compliance market. The other thing that we've been able to do, and I already shared the Penvest story, which is both exciting and still a little complicated, but we've also used New Markets tax credit financing. We have borrowed money through our relationship with a land trust. So the Conservation Fund got a program-related investment from the McKnight Foundation that was then relent to Lyme Timber for that project in Wisconsin. And we are one of the largest borrowers from the federal farm credit system in the eastern half of the United States. That's essentially a co-op. So all the borrowers participate in a dividend relationship. So right now, even though interest rates are going up rapidly, well, interest rates are going up as I speak, we're borrowing money in a more conventional way with an understanding about subordinating to easements and things like that from the farm credit system at about 3.5% fixed. So besides investing in forests, up and through Fund 4, we included these additional strategies and actions as part of our investment activities. You heard from David Hoffer on Monday about our mitigation bank, or maybe Tuesday morning about our mitigation bank, stream bank, and habitat bank investments. I just mentioned our sort of conventional carbon, where we put it into one of our operating forest transactions. We've also done what I call carbon-centric investments, and we did one of those just outside of Bend, Oregon last year. I don't know why it was called a ranch, because it was 87% forested, but it was a ranch. And it had very high stocking, meaning a lot of tree density per acre. So we returned more than half of the investment. So our basis, what we actually paid for the property, through the first issuance of improved forest management offsets. It happened to be in a watershed in Oregon that had direct environmental benefits to California. So as California has been changing its requirements for its carbon offset program, this property, even though it was outside of California, met the test for a direct environmental benefit for California. And then this is sort of what I call our emergency room medicine work. We never can build a pipeline, but because of our relationships with conservation groups and state and federal agencies, we get called in at the last minute when no one else can put a deal together. An Italian family from Turin had owned a property that was within the purchase boundaries of Acadia National Park for about 30 years. They did absolutely nothing with it, and then proposed a 1,000-unit eco-development. Oxymoronic term, but all of which could be seen from the top of Cadillac Mountain, the high point in Acadia National Park. Maine Coast Heritage Trust, TPL, Park Service directly just couldn't negotiate. We could. So they wanted to close by the end of a calendar year for certain reasons. We started our negotiation in October. We were able to close. We owned this for a whole day. Because the day we closed, we received a letter from an anonymous private foundation who wanted to make a centennial birthday gift to the National Park Service. And we had underwritten the investment thinking we'd go through 3 cycles of Land and Water Conservation Fund money to Acadia National Park and had an option relationship with Maine Coast Heritage Trust, but we ended up owning it for a day, and the IRR was remarkable. But we didn't really know much about this foundation. We now know a lot more about this foundation, and we wanted to make sure they didn't forget to gift the present to the National Park Service. So what we did was sell an option to Maine Coast Heritage Trust that gave Maine Coast Heritage Trust to acquire the property for $10. So so I actually had the $10 bill. I could put it in an envelope, send it to Maine Coast Heritage Trust if that family foundation forgot to make their gift to Acadia National Park. And then part of that was to preserve our reputation, like we're flipping it to a foundation after the Park Service asked us to buy it. Now they understood the transaction, but we just wanted to make sure we kind of had belt and suspenders in place that the transaction would happen as described. We were, I wish to say we came up on this, but it was about 5 years ago that principally our Western European investors asked us to start using the UN Sustainable Development Goals as sort of metrics to describe the mission or non-financial outcomes associated with our investments. I never show this slide in West Virginia because it's like communism, but I'm happy to share it with you. And lastly, a few of you have heard a little bit about this. So in 3 different transactions, Lyme Timber over the last 2.5 years has acquired, well, it's exactly 1 Rhode Island's worth of land on the Upper Peninsula of Michigan. And why in the world did we acquire it? It's kind of obvious if you look at this map. It connects 2 national forests. It is critical watershed property for 2 of the Great Lakes. It has 40 miles of the Northern National Scenic Trail that goes through the western portion of this property, touches a significant amount of state wildlife management area lands, state parklands in Michigan, and state forest lands in Michigan. So everybody thinks of a checkerboard in the western, west of the 100th meridian as land ownership patterns. This was a checkerboard as well, and we're filling in the pieces. We will spend the next 10 years. We underwrote this investment with the notion that it was so large, for us at least, and so large a potential user of public conservation money that it's not in the first 2 years or 3 years or 4 years, but it's going to be over the next 10 years that we estimated it will take to achieve the durable conservation projects. We've already completed 2 fee acquisitions to the National Forest with the help of the Trust for Public Land on this. We're in the midst of one of the largest forest legacy project proposals ever on this, with great support of Michigan Department of Natural Resources and a commitment to do the private half of the 25% match from the Michigan chapter of the Nature Conservancy. So I'm pretty excited about this. The other thing that is remarkable, there are 31 employees in the operating company that manage the property that are just great folks and sort of great eyes and ears and representatives of Lyme in this landscape. And I think I'm gonna, these are, you will get this, including the folks online. These are, if any of you are familiar with the connected and resilient landscape mapping that the Nature Conservancy does, this is probably the most highly resilient location in the Great Lakes region. So everybody thinks, oh, wow, that's nice that you use that mapping. Well, there's 2 reasons we use that mapping. We do have a consulting business. We introduced Mark Anderson and his team to the Darcy Duke Charitable Foundation 11 years ago, and they've been supporting this mapping. So that's kind of cool. Secondly, if we acquire land in more resilient locations, we are gonna benefit from cost savings and things like road repairs, culvert replacements, less storm damage. And that goes right to the bottom line of results that we deliver to our investors. So if you were to put that map that I didn't spend any time on that showed all of Lyme's properties around the country and overlaid the connected and resilience landscape map, we own land in some of the highest resilient attribute locations in the United States. And I'm done. So the purpose of the next part of our time is for you to ask easy questions. No, any kind of question or comments. Katie will continue to monitor to see if folks online have any questions, but it's a free for all now.
So, hi, Trey with Delaware Highlands Conservancy. So you're purchasing land in forested land in resilient areas. And one of the ways that you're making the return on it is through the sale of carbon credits. Excuse me. I read recently an article in Bloomberg from Lyme Timber Company CEO about questions of additionality in those landscapes. And I'm wondering how you're navigating that going forward and how you see that evolving.
So it's a great question. A little bit of background is we were an early adopter, early participant in the California compliance market. The protocol was not perfect in the early days. In fact, it was so, let's say, imperfect that there were incentives to put land in where arguably there was no additionality on that property. So an example would be in the first 2 years, the so-called pre-compliance years of the California market, you could put land in if a forever wild conservation easement had been on that property for less than a year. Why were they doing that? They were trying to build a market. So we checked every box in the protocol. We've been verified, we've been registered, we did everything we were supposed to do, but that's an outcome of the early years of that market. We have decided as a company that we want to be paid, we think, to change our behavior and not just put carbon offsets or sell carbon credits on things we can never reach with a piece of equipment, or we're never going to be able to afford to build a road to do the harvesting in that location, or there's no markets for the timber products that are coming off, and therefore there isn't going to be any harvesting on that portion of the property, that we're putting a line in the sand saying we want to be compensated for behavior change. If we're going to reduce the intensity of our harvest, if we're going to cut less than annual growth, we want to be paid. And we've done an analysis across our portfolio. Sometimes that's going to cost $30 a ton. Sometimes that's going to cost $60 a ton. Now, a conservation easement in place reduces that cost because some of the things associated with conservation easement are delivering some of the things that we would like to see a carbon credit deliver as well. So an example for the one that costs $60 that we want to be paid $60 a ton, if we put an easement in place, well, then that price goes down to $30 a ton. And many of our lands are combinations of conservation easement encumbered lands and carbon credit encumbered lands. That's why we wrote that article.
Question here.
Yes.
So Jordan P. Howell asks, how are changing EU regulations impacting the numbers and types of European investors you are seeing? And would you care to speculate on how changing SEC rules might make your products more or less attractive within the US context?
So what's going on in the European Union started 5 or 6 years ago are climate impact disclosure requirements for companies. So whatever their business is, they have to abide by, and Alicia, you may have to help me here, with a description of what their business does that produces greenhouse gas emissions, and then looking through scope 1, 2, and 3 of the Paris Climate Accords, what are they doing about that? And are they changing their business activities? Are they buying offsets? Are they making insets, meaning investments in natural climate solutions as part of their supply chain, things like that? Under the SEC, we have the first climate disclosure requirements that the rules are under review right now by the SEC. They only relate to publicly traded companies, which would leave most of the timber investment management organizations out, except for the publicly traded real estate investment trusts, such as Weyerhaeuser or Rayonier or groups like that. I see more and more interest. We're seeing, Lyme Timber is seeing more and more interest from EU-based investors because of these disclosure requirements. To keep going in EU, there's now a biodiversity disclosure requirement in the EU as well. So whatever their activities as a corporation, as a company are, they have to disclose the biodiversity impacts as well. And then they have to look at what are they doing about those impacts? How are they mitigating or making up for those impacts? I'm a glasses half full person. I hope that happens in America, maybe, but I think that's going to be a ways off in the States.
Hi, Peter, Kip Wimmer, Defenders of Wildlife. Other than supporting your local land trust, national land trust, and possibly identifying properties that could be conserved through your investment fund, how can low wealth individuals participate in, I mean, if we're personally highly motivated and really like what you're doing, how can we invest and benefit from this wonderful work?
It's a great question, and I'm like honored that you're asking, but we have to abide by the Registered Investment Advisors Act and the SEC requirements about basically the net worth of investment entities. So there are rules, and we can go through those. We have from time to time figured out ways, not the easiest thing in the world, for investments to come through folks' IRAs, and we've done that in the past. But I would argue that the better, and don't ask me which one is the better, but you can invest directly in the publicly traded real estate investment trusts at modest amounts. One of the craziest and neatest sustainable ag fund called Iroquois Valley is actually a registered REIT. You can, I think the minimum investment is $5,000 in Iroquois Valley if you want to invest in conventional land that's being converted permanently to organic management. So I'm happy at lunchtime to share some other ideas about that.
Thank you, Peter. Nathan Warwick. Looking at what the colleague was saying about that you guys have already a great track record of managing funds and deploying funds, closing transactions, exiting. You guys, or you in your professional career, have engaged in DPOs for like aggregating people that are not accredited investors but can deploy small ticket sizes?
No, it's a great idea. You know, under the Obama administration, there was a pathway created to do exactly that. We have elected not to go there because we're a little lazy. And you know, part of it is, I'm not going to say it's easy for us to raise capital, but it's relatively easy for us to raise capital. So the track record in our funds is at least 50% of the capital in each fund is coming from returning investors. So an investor in a previous fund.
And what were your like leads be for an emergent fund manager or people that are raising funds to deploy in these kind of transactions?
Can you just repeat the first part?
What were your like directives for people that are first time raising funds?
So I've talked a lot of people through first funds. First funds are hard. First funds are really hard because you don't get to do what I get to do, which is show the track record of 6 previous funds or 2 previous funds or even 1 previous fund. So for 2 groups that I have helped a bit, I've asked them to skip that idea and warehouse. So go to 2 or 3 ultra high net worth family offices that like you, that understand your strategy, that really think you have something worthwhile doing, and have them make direct investments in the assets you want to manage. And if it works, 3 or 4 years later, you wrap a bow around those 3 or 4 or 5 direct investments, and you just created fund number 1. So Sustainable Land Management Partners did that. Dirt Capital has done that, and it's worked really well.
Got one other question.
Yeah.
Jordan has a follow-up. Are you at all?
He keeps asking a lot of
But
questions.
he does say thank you. And he
All right.
appreciates it. Are you at all concerned about a flood of money approaching firms like yours without investable projects to direct it towards?
Great question all the time. It's why we're not raising capital right now.
Ben Rushcroft with American Tourist. I'm curious, through your experiences, what you think are the greatest shortfalls or limitations of Lyme's model and approach. Like, I see that it's easier if you're acquiring a lot of land that already has high value timber on it and getting a return from that, either from carbon or timber, but maybe what are some
Well, no.
limitations of that?
So we have actually bought land that has been aggressively managed in the past. So an example of that, we bought the headwaters forest for the Connecticut River. It was 145,000 acres, but if you looked at the cash flow for the first 10 years of timber income, it was pretty modest because the previous owner had intensively harvested that property. So the way we were able to justify economically making that investment was a back-to-back easement transaction. So the day we acquired the property, we were paid for the easement. So literally 55% of the capital, so 100% of the capital was out for about 6 hours, and 55% came back 6 hours later. And that gave us enough cushion, so to speak, that we could tolerate relatively low annual income associated from timber harvesting till the forest regrew to a point where that income went up. One of the things that we're bad at, unless we can bolt it on to an existing transaction, is smaller deals, which is very uncomfortable for me because if any of you have spent time with me, I can like fall in love with smaller forests. But we have this discipline within our firm that I don't get to get away with that. So from many land trusts, we work at a scale that's just not helpful to those land trusts. The other thing that's a big limiter to the amount of, it's why we scale our funds to a certain size, because we look at, we are the most frequent user of the land vote database that TPL maintains. Because we scale the size of our funds based on what we can learn and predict about the amount of public money that's going to be available for working forest conservation easements around the country. That lately has been going up dramatically because of the doubling of Land and Water Conservation Fund and some of the money in the infrastructure bill and a variety of other things. But that's always been a key component to scaling the size of our funds. Landvote.org. And you should all join me as regular viewers of that.
Thanks, Peter. The Whelpton Conservation Finance Network. I happen to know that you're considering and exploring carbon as part of one of the potential strategies associated with the Great Lakes, timber Great Lakes. And I think, could you comment a little bit on some of the market dynamics that are part of that exploration and discussion relative to the parcel, relative to the price of carbon?
So we actually went pretty far in a partnership with the Nature Conservancy, with the Working Woodlands Program of TNC, on this land when we first bought it. And then we stopped for two reasons. One, our experience with carbon is we are better off from a financial point of view doing the working forest conservation easement first and then doing the carbon, then doing the carbon, and then doing the working forest conservation easement based on a whole bunch of appraisal issues. Second, this property was pretty well, it's been well cared for and well managed, but intensively managed for decades. So the stocking, the tree density per acre is below the regional average, which kicks us out to a great extent of the California compliance market. We have yet, but we're looking at it here, we're looking at it in the Adirondacks as well. We have yet to do a voluntary carbon market transaction. So what we've decided to do here is it'll probably be in 2 or 3 phases, approximately 150 to 200,000 acre working forest conservation easement with the Forest Legacy Program and Michigan DNR funding with the easement held by the state of Michigan. And as we do each phase, we'll begin a voluntary carbon project on that phase. Yes.
That question, Tim Williams asks, are there any standout examples that follow Lyme's model, but with livestock farming rather than timber?
I don't know about livestock farming, but I certainly would say that sustainable land management partners are looking at investing in agricultural land in jurisdictions, full disclosure, I sit on their investment committee, but in jurisdictions where there's money for farmland conservation easements as well. Dirt Capital has definitely done that, and it actually includes some livestock operations. So those would be 2 resources or 2 connections we should make. Eric.
There, Stein around the National Park Service. This is more of a nuts and bolts question and has to do with, when I look at this map and I see all these parcels that you've assembled into ownership. And I'm just thinking about the various resources you described to do that. And I'm just thinking about the folks who want to do this and are looking at doing it. And they're thinking, well, that's easy for you. You've built up an entire database of language to populate the forms and the documents and everything that you need to file to make these kinds of transactions happen. And they're like, great, I get it in theory, but I don't even know where to start, like from a paperwork standpoint and how much time that takes. Can you speak at all about the human resources aspect of your company doing these things? Because at macro, it looks really easy and it makes sense. The micro, I can imagine people not even knowing where to start from the forms and who to hire to help them do this kind of thing.
Great question. Well, there are over 300 people that work within Lyme Timber. There are only 19 people in our management company. And really, there are only 3 or 4 people who work on our conservation projects. Now, they're all remarkably smart, experienced, bright, connected, networked people, but we also rely a great deal on our land conservation partners for this work. So in drafting of a conservation easement, it's really usually three parties. There's the state or federal agency who's going to be the easement grantee, the recipient, the buyer, the owner, the holder of the conservation easement. There's an intermediary, typically a land trust, who has experience and familiarity. We don't partner with a land trust typically on their first working forest conservation easement transaction. We're looking for partners that have experience. And then there's us. My colleague, Tom Morrow, has done more than 1 million acres of working forest conservation easement negotiations. We have an inside attorney and an external out of county, private attorney in a law firm who have more experience together on working forest conservation easements than probably any 2 people on earth. But it's a small team that we built that experience. I would say going to something like conservation finance boot camp is probably a step in the right direction. Continuing to read and connect to the CBA produced website for CFN. There's a fair amount written about this stuff. Each of the state forest legacy, the forest legacy program coordinators at the state level, in state natural resource agencies are great resources. A lot of our work is template work. So we've done it many, many times, but other people have done it many, many times. So nobody should think you actually have to start absolutely from scratch on this. The political dimensions of this get a lot more complicated. And sometimes we're relying on our NGO partners, or in the case of Michigan, we hire a former fracking lobbyist to help us. Now, I had a little trouble explaining this to my wife, but that was the right person to help us navigate the political reality of Pennsylvania. Alicia.
Alicia from the finance there. To what extent?
You're introducing yourself?
I apparently we have
Okay,
to.
good. Right.
Maybe I got that wrong. I'm sure I got that. Anyway, I know that you only invest at huge scale. To what is there a minimum scale you think it would work at? And also, to what extent do you look at the kind of social side and sharing of benefits and ensuring that sort of communities aren't driven out by this work and things like that?
Yeah, so I didn't go into the SDG, the Sustainable Development Goals. Yeah, but the social dimensions of our work, the community, what we call the rural community development dimensions are critical. We have some investors who candidly are much more interested in the safe, well-compensated, well-benefited, significant training we provide to the employees of these operating companies than our conservation outcomes. We almost always work in economically distressed zip codes. It's just, there is a remarkable coincidence in high biodiversity attribute, northern hardwood forests and low wealth communities. I don't know exactly why. Well, I do know, but anyway. So there are a number of foundations who invest with us who care about people and communities and really like the fact that these are working lands, that we pay property taxes, that we employ people, that there are direct, indirect, and induced economic benefits associated with our investments. I mentioned bolt-on. So if you've been, well, very few of you have been to around, but we have this long hall and a deal, a lot of deals come in at my end of the hall and I walk up and down the hall and they close their doors when it's too small. So I have trouble, standalone investments that are less than probably 25,000 acres just are not going to get the attention. They get my attention, but nobody else's attention, unless it's like over here or another private property over here, where we can leverage the existing operating company to put more land into their land base without starting from scratch and building an operating company. There are a number of smaller TMOs that would work at a smaller scale, not all of which have the experience or track record of delivering conservation, but some of them do.
Time for maybe one or two last questions here, and then you can continue to fit your questions in over the break.
Hi, Mike Mungi, Kirago for you, International Conservation Network. I'm curious, I mean, as far as I understand it, Lyme doesn't operate outside the United States.
We're so brave, we go all the way to Canada.
Oh, great. I was curious whether you could speak to who you consider equivalent peer companies in the European sphere who tend to also have an international reach in the Southern Hemisphere.
Yeah, there's actually a company that is headquartered 5 miles away from us called Global Forest Partners that does not do, I don't think they do any domestic, any US forest land investing. They only work globally. New Forest, based in Melbourne, Australia, but with a big presence in San Francisco, a big office in San Francisco in the United States. That's the firm that just got acquired by Nomura Securities, the Japanese financial institution. They have a great global reach. And both of those firms, well, particularly New Forest, has extensive experience in carbon, both in the US and outside the US, and extensive experience with conservation restrictions, conservation easements, conservation covenants, conservation agreements.
Last
And
question.
Ellen.
Ellen Lott, the Nature Conservancy. Peter, can you give us your thoughts on where the voluntary carbon market is going in the next few years, particularly related to registries, and seem to be a lot of new programs coming out and jumping into the fray and trying to figure out what are you looking at there?
Good question. We probably, do we have another hour and a half? Yeah, I think in the case of the US, I think American Carbon Registry and VERA are tightening and improving their protocols in a pretty big, dramatic way, possibly due to that Bloomberg article or the ProPublica article or a bunch of other articles and some unfortunate examples. I won't name the name, but like the nature, no. Or Lakes Region Conservation Trust or Lyme Timber for that matter. I do think there is kind of consumer interest a bit in the quality of carbon offsets. And they're now, I would say, stricter, look at what Ceres is doing and looking into this, look at what a number of other advocacy groups who understand nature-based climate solutions, but are looking at raising the standards associated with the voluntary market. There was a pretty big shift last week with the 1 year carbon stuff that NCX does. They did not get their protocol approved. Notwithstanding, I have some very good friends who work there. I'm not a big believer in selling a carbon credit for just 1 year. So that was something that a lot of people had hoped for, but it seems to be going in the other direction right now.
All right, well, we will have time to barrage Peter with continued questions if you're here in the room. So we mentioned that we're going to share slides, right? Thank you, Peter. We're going to go ahead and conclude the live stream. Thank you, folks, for joining us. Thank you, Peter. Please join me. For our live stream folks, thank you for joining us this week. This is the conclusion of the last live stream session. So we'll share recording shortly, and just really grateful for you all joining us from afar so that we can extend the classroom just a bit. Thanks, folks. And